Welcome to the final day of Entrepreneurs Week here at Farrer & Co. Perhaps more of an EE week than any of us had imagined when planning started for all of this late last year, but there we go. I'm Andy Peterkin, I'm the head of Fintech at Farrer & Co. And this session is a panel debate around the subject of how Fintech is transforming banking and asset management. Just to move on then to set the scene for our panel discussion this morning. Whilst we're obviously in present circumstances not all physically in that location today, the City of London is of course a fintech hub. And as with everything these days, I need to preface these figures with the pre-COVID marker, and no doubt we'll come on to discuss the impact of COVID on all of this during discussion. But a recent survey found that the city receives 80% of the fintech funding, all fintech funding that comes into Europe. During Q1 2020, there was $114 million worth of inward investment. Just to set that in context, that's almost as much as the whole of 2017. And that study found that there were more than 1,100 firms that might be classified as fintech in the city. So clearly, fintech is, to this point anyway, a success story for London. And possibly that's no surprise, given that London is a global centre for the industries which fintech is looking to disrupt. And in particular, of course, banking and asset management. I'm a regulatory lawyer by background, and something that certainly surprised me maybe over the last 10 years is how wholeheartedly the UK regulators have kind of embraced the fintech revolution. Andrew Bailey, who of course now has been elevated to Governor of the Bank of England, recently said that regulation has been traditionally summed up by three verbs: to forbid, to require, and to permit. He also went on to say that a fourth verb should now be added, to enable change. And indeed, to that end, the FCA has gone so far as to get itself a Director of Innovation, which might have raised the Governor's legendary eyebrow in years gone by. This session is going to focus primarily on banking and asset management. I suppose to the layperson of observing the fintech scene from the outside, what they might refer to as banking and what a lot of the panelists and I would refer to as payments have probably been the most publicly recognised aspect of the sort of fintech world to this point. Banks, of course, had a monopoly on payments for many years, from ranks of clerks sitting in clearing halls in Threadneedle Street through Swift, Bax, and all the rest of the infrastructure. And it's still all structurally very important. But models featuring innovative uses of technology, from wraparound giants like Apple Pay and PayPal, to smaller models that seek to address single issues, such as payment security. Traditional banking institutions are being simultaneously challenged and themselves seeking to adapt with homegrown solutions and strategic partnerships. We see the likes of Citi and Barclays running, large and very successful innovation labs, really seeking to get in on the ground floor of technological development in the financial services space. Recently in the banking sphere, we've seen fintechs move into what we might call quasi-credit. I'd probably be shocked by their in-house lawyers for suggesting they're credit providers, but you've got firms like Klarna and Splitit. Of course, you can now access that sort of thing directly via online retailers such as Amazon and John Lewis. It's plugged directly into those retail platforms. We've also seen the likes of Revolut scaling what was long considered, I suppose, the Everest of banking fintech and applying for full banking licenses. So you've got fintech participants in the banking space maybe moving out of the shadow of the traditional banks and becoming competitors, perhaps, rather than simple add-ons. And certainly in terms of banking licenses, what is certainly striking to me as a regulatory lawyer is seeing the Bank of England, PRA, and the European Central Bank providing pathways for that competition to happen, and indeed facilitating it. Moving to asset management was probably in some ways, it is probably in some ways a less developed frontier than the banking payment space. Certainly talking to my clients, there's always been some skepticism as to whether asset management is as vulnerable to disruption in the same way as banking is. One thing I hear quite a lot is that there will always be a market for the human investment manager. Very much what we see is a focus on analytics and asset allocation. So what you've got there is tech as a helpmate to traditional asset management rather than a direct replacement. I think there was a study by PwC a little while back that said only 30% of asset and wealth management firms were having active engagement in the fintech space. Contrast that with banks. If there's a bank that's not engaged in the fintech space, I'd be very surprised. However, there are tailwinds, I think, behind increased fintech participation in the asset management space. Going all the way back now to the asset management market study, the FCA obviously identified the management gap, that segment of the market which increasingly has assets quite often tied to retirement that require advice and possibly management, but which perhaps are not on an individual basis of a scale that makes sense to a more traditional asset management house, charging the fees that traditional asset management houses charge. So we've seen the rise of robo-advisors, scalable, numerous property and investment platforms, facilitating direct investment into an otherwise difficult asset class, and similar platforms with other asset classes, I might add. So broadening the scope there of investable assets for a mass market. So that's an overview, I think, of where we've got to this point in the banking and asset management spaces. I think what I'm interested to hear, certainly from the panel this morning, is threefold. The first is, what has made London so successful in terms of being a fertile breeding ground for fintech to this point? What more can be done from a policy and regulatory perspective? And in practical terms, what do we think the roadblocks, the difficulties, and the risks are to the fintech space in the UK? We've got a very distinguished panel this morning. Just to introduce them to you all briefly, Hazem Naquib, who you can see probably at the top centre of your screen there, is a financial and regulatory technology expert, a general partner at the venture capital firm 7BC, and managing partner of the Sentinel Capital Group. He advises and consults for multinational organisations and governments on how to develop their digital strategies and on how to understand, leverage, use and implement frontier digital technologies in the digital economy. Secondly, we've got Dr. Ruth Wandhofer. She is a partner at Gauss Ventures and an expert in the payment space. She's had a diverse career across regulatory policy development, banking, fintech and regtech, mentoring, investing and consulting. She has been at the centre of the evolving digital ecosystem over a 19-year career. Finally, we've got James Borley, who's a client director at Compliancy Services. James is, again, a familiar name to many in the payment space. He leads Compliancy Services payment services practice, and he previously spent 22 years at the FCA, notably in charge of the payments authorization team. And he's also worked in developing UK and European guidelines around payment. So that's our panel for this morning, and hopefully I've managed to set the scene a little bit for them. I think my first question that I'd want to just throw open to the panel is a very general one, just to take their temperature. Perhaps we'll kick off with Hazem. Hazem, to your mind, what is it that's made London, to this point at least, as successful as it has been in fostering fintech development and investment?
Thank you, Andy, and a pleasure to be here, everybody, with my co-panelists. The very simple answer is I'm not quite sure. I think there's a variety of variables and factors. when we look globally at different markets that are so advanced from a fintech standpoint, they typically have a variety of similarities, one of which is usually an oligopoly within the banking sector. Two, they have very, very strong universities and talent pools and apprenticeship programs with which, you know, individuals develop transferable skills that they can then move into financial technology roles, running fintechs or working in fintech positions at different organizations. And then, of course, and I think all of us on the panel are going to mention this, which is the 800 years of common law, right? In London, you have a lot of the clearest and most robust frameworks, regulatory, but also on the common law side, regimes when it comes to insurance, banking, and so on and so forth. And the other is just geographically, right? Both as an entry point for the rest of Europe, but also as a point between East and West, right? And so that's why no matter where you go in the world, if you say you have you run a bank in the UK and you have a UK banking license, it means something. If you run an organization in London with your offices on X street, it means something. And that's the culmination of a very long time building up the talent pools, building up the banking sector and the common law and regulation and so on. So I'll stop there and happy to unpack any one of these different pieces. But ultimately, the underlying regulatory piece and talent and existing infrastructure in banking paves the way to make it a lot easier to develop those different components. But what it doesn't do, however, is it doesn't operate like many jurisdictions that are missing that infrastructure that allow much faster leaps in financial technology from a demand standpoint from businesses, enterprises, and consumers. And I think that is what we may spend a little bit of time trying to address. How do you get past the legacy? How do you get over the regulatory and legal barriers? Because there's going to be a threshold at which it's going to act a little bit like a ceiling that needs to be broken through.
Ruth, I know you sit very much across the regulatory space, both here in the UK and in the EU. Do you kind of agree with Hazem that actually the regulatory ecosystem in the UK has been a big factor to this point?
Yeah, and I think maybe to add to that, it's the way the UK has approached EU law, not only from an implementation written law perspective, but also how, as we mentioned earlier, how the different bodies are actually embracing innovation and trying to learn and foster these things. So certainly the FCA over the last 10 years has become a standout regulator and supervisor to promote innovation, to look at new innovative areas early on. Obviously the sandboxing regulatory piece was really innovated by the FCA and became ultimately a global approach with GFIN, but also inspired many other markets to do the same. And I think even if the UK, and I'm sure we're going to talk about Brexit a bit later on, even if the UK ultimately splits off from the EU regulatory regime angle, there will be continuation in certain types of measures where for institutions to both offer services in the UK and in Europe, alignment will be useful and will actually fertilize the ground for fintechs to grow from the UK into European and international dimensions. And again, there will be a number of measures coming down the pike. I think one other point to mention is also industry bodies. The UK has many industry bodies like many other markets, but bodies such as Innovate Finance have certainly over the years developed a very significant international standing in terms of collaborating with other markets in Europe and outside, very globally, attracting talent to the UK. So back to the talent point, a lot of firms that may actually develop and start off in other markets always want to at some point come to the UK. And the only thing that maybe hasn't mentioned is the language. Obviously English being lingua franca, we've got the common law history, the language, the geography and the talent and the support by industry bodies as much as regulators.
Okay, and maybe just passing over to James as someone who's sat inside our regulator here in the FCA. Setting aside factors to whether we agree that the regulation has been a big factor, do you kind of agree with the premise that actually a factor has been the degree to which the regulator itself has kind of embraced fintech and kind of sees it generally as a good thing? that the UK banking industry and asset management industry should be embracing?
I think that's true, Andy. And morning, everybody. And having been involved myself in setting up the regulatory sandbox and Project Innovate myself, I can see that there was a definite desire from the regulator to encourage innovation and technology, but the challenge that it had at the time, and it still does to a certain extent, is that it needs to accommodate within the existing legislative framework, and it cannot act unilaterally to say, okay, fintech, you have a great idea, let's run with it. It needs to be able to grant a license, or whether it's a limited license or a full license, within the set framework of the regulatory perimeter. And so key to that is to influence government and HMT, Her Majesty's Treasury, to include innovation within its thinking and anticipate the next regulatory change, such that it can deliver a framework within which that innovation can be delivered legally for a start, and with the encouragement of the regulator. And I think what Ruth said earlier is absolutely right in terms of linking this to the European framework in terms of, and again, we'll come on to it later, the current passporting arrangements, and the fact that the UK was instrumental in drafting many of the single market directives under which we currently operate and recognise banking license, asset management license, payment licenses, etc. So I think there is definitely a desire from the FCA to be as flexible as possible to fintech and new innovation.
No, and that's certainly something that rings true in my interactions with them. I suspect that a lot of people who are with us for this discussion this morning, it being eWeek, are broadly speaking entrepreneurs. That is, they are people who are likely to be involved in new fintech startups, and I'm sure they'll be wondering, having read your CVs, what it is that you think, perhaps from Hazem and Ruth's perspective, make for a good fintech investment in the payments and asset management space, and from James's perspective, what a regulator is looking for. So should we take Hazem and Ruth's views on that first? With your investor's hat on, what is it that you're looking for in a fintech startup in terms of viability for investment?
Ruth?
Sorry, I'm muted. Here we go. Yeah, I think the first thing that we look at, and whether that's payments or other digital disruptive or big impact technology type approaches, is really the background of the team and the understanding of the actual issue they're trying to solve. I've been mentoring fintechs for the last 10 years, and in the early stages, we've seen a lot of people with great ideas, but no understanding as to what the industry needs, how the industry operates. And Andy, as you said at the beginning, disruption was a big theme over the last few years, but I think increasingly it's about partnership as well as serving the big institutions as well as the smaller institutions. London is still the banking capital of the world, and any technology and any approach that we tend to look at really has to understand the problem they're solving within the bank, within the asset manager, or the industry at large, which could even include infrastructures and other areas. So the understanding of the problem, the combination of the technologies, there's always a discussion around maturity of different types of technologies, sorry for that. So certain technologies are maybe less mature than others. It's about tested and tried things and the way you architect and combine those. And then from our perspective, even though we invest in fairly early stage, we certainly would like to see that there's a sales distribution type of pipeline agreement with some clients. So there has to be more than a minimum viable product, and there has to be at least 1 or 2 clients that are in the process of buying the solution, so that it starts to actually prove out the case. So it's not just theoretical, it becomes real. But really background understanding, technology understanding of the business model, and also really the approach around how can we reinvent or invent a new business model. if we look at an industry, for example, asset management, that still needs a lot of disruption in a positive sense to become a lot more efficient, how could you do things completely differently to today using technology and the right governance and the right approach? And I think that would be really the ingredient that we look for to make solutions very exciting and also sellable.
Just as I launch into this, I see we've got a question from James Goad, which is how do you pick a winner when there are so many fintech firms around there, and obviously some will not survive, which I think is probably the point that we're addressing. But Hazem, do go on.
Sure, absolutely. So of course, agreed with everything that that you and Ruth said. So I'll take a slightly different approach. We invest slightly later, so we're at the kind of Series A and growth stage, right? So we're looking at those fintechs, and my practice area myself is just financial services. We're looking at those businesses that are either fintechs themselves, which means they have some proprietary technology, or fintech enabled, right? So it's a financial services business that is driven by technology that they've both outsourced, built together, integrated, and implemented. So they have what we call moats, right? So a moat can be the access to data they have, it could be the technology, it could be whatever else. And that's what, you know, acts as their kind of competitive barrier and value proposition. But there's also something I'd like to dispel about innovation. For us, innovation, and this will be relatively widely accepted in terms of how we look at it, it's the mixture of a new technology and a new business model. When I say new business model, I really mean it. You're not doing the same thing as you know, the other incumbents within the sector. You have a new way of extracting value in a positive way, but also a new way of delivering value to the end consumer and end client. So that's how we look at it. The other thing is that innovation is predominantly about competition. So we're looking for the gaps currently in the market based on what incumbents in a particular sector are doing and what the environment is forcing them to move towards. For example, in SME secured lending, what we're seeing is the large incumbents shifting everything from a distributed to a very centralized model through call centers, removing the face-to-face because they can't handle it due to their cost-income ratios. They're far too high. That creates a fantastic opportunity for new, not challenger or neo-challenger, I dislike those words, but for new organizations, financial services businesses, to actually use technology to better cater towards SMEs, for example. So digital is not just digital. In fact, my view, if we look at the payments landscape in many of the companies that we've mentioned already, a lot of them, it's getting too inundated. So to answer your question, how do you pick one? It's getting too inundated where it's primarily driven on the retail side, on the payments retail side, by branding and algorithms. Everybody's fighting for the same pot. It's very capital intensive. It's not profitable. These are problems. So although fintech has gone very well in many different ways and has really spurred innovation from incumbents to new businesses, they serve as learnings to what should happen and how new business models are going to be created, but also exactly where the gaps begin to kind of extend. And those are the areas that we try to pinpoint in terms of trends that we would like to enter based on where businesses and early stage businesses are going. The other problem that we often see is twofold, and I'll just say this very generically. One is there's often a massive gap between technology teams and the commercial side. This is across the board. We've seen it everywhere from pre-IPO companies to companies that are just out of the dorm room. We're always looking for that to be addressed. The other one is when we look at an organization, we want to make sure that the board and management have directly aligned values. Because if we're going to join a board, for example, and we're going to begin supporting and working very, very closely with management, we want to make sure that there's congruence there, or else, in our view, the company will most likely die and will not be successful to the degree with which they have the potential to be.
Okay, and James, from your perspective as someone who spent a great deal of time and has much experience as a regulator, when that voluminous and expensively prepared application pack lands on your desk, what is it that makes you glad to be there, and what is it that makes you put your head in your hands?
Yeah, I think it's a balance between the volume of it. If it's too much, I get worried. If it's too little, I get worried. But I think the application pack itself certainly is largely dictated by current European standards. And so the phrase I use is that whilst the information that each regulator in Europe is being provided is essentially the same, according to probably for payments, for example, the EBA authorization guidelines, what they do with it is different in each member state, which again goes back to the first question about possibly why London and the UK is more attractive than other jurisdictions. But in terms of the application itself, I think there are key elements that need to come out immediately to the FCA. One is, what is it you're doing, and is it regulated? Certainly from a consultancy perspective, we get approached quite often by firms that say, I want an FCA license. And the question is, well, what are you doing? And as they explain it, there is nothing that falls within the regulated perimeter. So whilst they may be desirous of an FCA badge, the FCA is not going to grant a permission to something that it can't regulate.
Yeah.
And the second point, I think, is, and it goes back to some of the comments that have been made earlier, is in terms of market saturation. What research have you done to suggest that your innovation, your big idea, is going to be successful in the marketplace? Then we're looking at personnel attached to the business, and there are a number of aspects here. One of which is mind of management. Occasionally, we see the UK as being attractive for overseas investments and overseas fintechs. However, there is an absolute requirement that those businesses are located in the UK, and located doesn't just mean a company's house registration. It means a proper head office that is demonstrated by a resident board, or the majority of the board being resident in the UK. And also knowledge and experience of navigating within the regulation. So it's quite, fine to have that understanding of your product and the tech that sits behind it. And to Hazem's point, the gaps between tech and commercials, there's also a gap between tech, commercials, and compliance as well. So you need to have personnel that can bridge all of those gaps. And ultimately, that you're bringing to market something that is good to go. The FCA has a phrase that it expects applicants for authorization to be ready, willing, and organised. And by that, they mean the reality is that the FCA will take a number of months to process an application, and those that have experienced that already will probably agree with me. However, the expectation is that it could take a couple of days. It has happened in the past, certainly when I was there, for certain types of application. In which case, when you get granted your license, the expectation is that you are ready to use it. So again, your product development needs to be in such a state that you are good to go.
Yeah. And one thing that's come out of the applications that I've dealt with recently is a real focus on, I guess, consumer security. Obviously, a lot of these platforms are tech-driven. A lot of them are extremely innovative, and it seems to me that the FCA is, extremely keen to ensure that people who are using tech-based financial services are protected in a cybersecurity sense. And I know, Ruth, this is a big area of interest for you as well. Is that something you've picked up, James?
Yeah, very much so. And there's one other point I was going to mention that sort of aligns to your comment, and that is that FCA will be more receptive where there is a consumer value add to the product, and that sort of ties into the security that would sit behind it. And obviously, PSD2 has introduced certain new requirements in terms of IT data security. So it is something that the FCA is looking at more closely, and we talk of a risk tolerance within the regulator to allow it to process the significantly higher number of applications that it gets than other regulators. But that risk tolerance doesn't extend to security. That is one area where they are looking closely at any application.
Okay. And Ruth, does that sort of increased focus that James talks about chime with you?
Yes, so certainly if you look at it first from an investment perspective, we look at companies, particularly around the security and cyber resilience angle, because of course, all of these digital companies somehow deal with data. Data is somehow always the asset. And there are ways to store it, to move it. Some companies only use encryption interfaces to just move it on, but there will always be some touch point around data. So if the architecture isn't resilient, if they haven't got the right measures across the board to keep the data secure, then of course that is already a massive gap. So I would encourage every fintech business that it's in its build-up stage to particularly look at security robustness from day one. It's not necessary maybe to have a big information security officer role advertised from day one, but it has to be part of the design of the product and the whole IT infrastructure that sits behind it. The same, of course, maybe back to James's point, goes up from the regulator perspective. The EU has specific security rules in the GDPR, PSD has security and protection rules around data, but there will be more and more focus around cybersecurity. We have the NIST directive at EU level, and this will just keep continuing. Whilst we've seen from a Basel Committee level in the past operational capital requirements for operational risk, I think this again also tackles security, and I wouldn't be surprised if even at that level it'll get tougher. So these measures will trickle through over time. So better safe than sorry.
Okay, now it's probably the right time in the discussion to start turning our thoughts to the future, and what the banking and asset management fintech space might look like in the next few years. Without the wish to turn this into a COVID seminar, through which we've no doubt all sat through very, very many over the last 6 months, to put it mildly. Hazem, how do you see investing in fintech in the post-COVID era as being different from that in the pre-COVID era?
Yeah, so investing in fintech in particular has continued, at least as far as we're concerned. Because the environment that this creates in terms of the types of organizations and startups and early stage companies that we're looking at just have more to offer, quite simply. From a cost standpoint and a balance sheet standpoint, they're able to be much more competitive with the incumbents, many of whom are busy with either capital controls or trying to run through a spur of acquisitions because they know they need to get that cost income down. Whereas the early stage tech startups and companies have a massive opportunity to begin either if they're on the enterprise side, which means they're selling to large asset managers or banks, this is the best opportunity they could have asked for, because now it's much easier to find an internal champion within the large 200,000, 300,000 employee conglomerates or banks or insurance companies. They are much more open to navigate them through their internal process, which typically they would get lost in, and they simply don't have the resources to keep up with 7 or 8 meetings a week of due diligence and so on, and go through 8 levels and phases of pilots or POCs. So that's changed. On the consumer side or on other angles where they're directly penetrating the market, similar thing. They have these massive gaps in different areas where many of the incumbents are retreating, and they have this creative space, right, where they're able to play around ultimately and to test different products and services, to take their time addressing customer and consumer needs. So it's a fascinating kind of catalytic event to take a crisis management approach to it, where some organizations are not going to survive, but those that are looking at it from that perspective of being able to be somewhat aggressive in the current market are going to be able to capture market share, as has been the case in previous, not identical, but similar situations. So we are very active. We know most other VCs and private equity shops, including in the mid-market, are incredibly active throughout this, because it's one of the larger opportunities that has surfaced from an environmental standpoint.
And touching then on the other subject about which we've all been to 1,000,001 seminars, Brexit. Ruth, obviously this kind of falls quite squarely into your area of interest. How do you see the interplay between the sort of UK and EU positions? And it's probably, positions will cover a sort of vast range of things going forward.
Right. On the off chance that I'll start crying, because that's how much I love Brexit. Maybe just briefly, certainly right now there's complete uncertainty for the financial services side of the story, of course, because this is the reason why all financial institutions that are UK headquartered, unless they already have their subsidiaries in the EU, they are setting those up. They're should make sure that they have their EU passporting in parallel to UK activities. I see exactly the same development with Fintechs that have already operations in the UK and operations in Europe and have used the license, because back to James and the FCA, so many institutions, payment institutions, you name it, e-money, they all tend, I mean, majority has their license in the UK and passports out. So those sort of preparations have already been taken place to make sure they have their pillar set up firmly in the EU. I think it's more for newcomers that are starting in the UK that they should already be planning, if they plan to expand beyond the UK market, certainly into the EU, to get themselves ready for the European side and be quite considered around which jurisdictions to pick for which type of service they want to be licensed in. There's some markets that are easier to get licensed than others, but some markets are maybe less credible than others. So there's a big choice here, whilst UK has always been really the place to be. And I think that's going to be the challenge. I wish that we would see a little bit more clarity, maybe that Brexit goes away altogether, but certainly for financial services and particularly also on behalf of the bigger banks, that uncertainty has resulted in lots of investments already being undertaken to manage the risk. One way or another, it'll be complicated when we get to it, but it certainly costs a lot of money in anticipation without any benefit.
It's also pushing, sorry, to add to that, it's also pushing early stage companies in two ways. One, they're being attracted by capital and investors from other jurisdictions, you know, for example, the US, different parts of Asia, and so on. The second point is, and so investment is usually tied to their expansion into those markets. And the second thing is, on their own, instead of beginning to look at least for Fintechs, instead of beginning to look at you know, expanding into Europe, as typically the process would usually drive them towards, they're looking at much more international expansions into markets that they normally wouldn't have entered into until much later in their life cycle, or that they would never have entered into at all, looking for those with similar regulatory regimes, or even those that are very, very different, that are much more underdeveloped, that they can take advantage of. So it's changing the expansion landscape that fintechs typically grow through in their life cycle, which we've seen for 10 years, and it's beginning to pivot very, very heavily.
Okay. And James, with your regulatory crystal ball out, are you able to sort of divine a likely way forward for UK regulators through the swirling COVID/Brexit mists?
Well, if I did, I'd be quite wealthy, I suspect. But no, I think it's, as Ruth sort of summarised at the end, it's a case of, you know, we know it's coming, but we're not quite sure when we get there what exactly it's going to look like. And certainly from a COVID perspective, I think what we have seen is you know, changes in different business models, certainly in the payments space. Quite literally, cash is no longer king, and where firms are cash based in terms of money remittance models, for example, then you know, they've seen a squeeze on their business, but conversely, online digital businesses less so. With regards to Brexit, I think, as again, as Ruth has said, you know, a lot of firms have taken the correct step to effectively replace their passports by a passport based on a license in another jurisdiction, and that's correct by and large. But in terms of new setups, they don't have that luxury. Is it a choice perhaps between following a dual path of authorization, setting up two companies, one in the UK and one in Europe? Or is it a choice between setting up in UK or Europe? And, you know, we may see some loss of business from the UK into Europe on the basis that the European market is likely to be more profitable than just the UK market alone.
Understood. I think probably a good summary of the future is that it's going to be a fairly frenetic 3 months, certainly with Brexit and indeed with the developing COVID situation. One thing I did just want to touch on with you all from the asset management side was the kind of rise and increasing regulatory acceptance, perhaps, of crypto assets. Obviously, we all spent a lot of time last year looking at the FCA's various position papers, then following on the Treasury's work on the new money laundering directive, which had quite a lot of specific material on crypto assets. How does the panel, I suppose, see that environment developing? Do we think that crypto assets are going to be more accepted in the future as kind of mass market investments, particularly with a view to things like retail savings, retail investment, which the regulators are obviously very keen to make as secure as possible? Do you want to comment on that?
Yeah, sure. So there's a lot to unpack in terms of the trend that we're seeing there. But fundamentally, you have those that are unregulated because they sit outside of the perimeter because they're new and novel and there is no regulation that applies to it, or they reflect something that is unregulated, such as a token or something like that, that serves no particular purpose, or they're acting like an asset class, or they're acting like a payment or a payment token or something else. Obviously, interestingly, in the UK and in most jurisdictions, payment businesses don't hold reserves with the central bank, naturally. But in some jurisdictions in Asia, that actually is the case, for example, in China, and it is possible. That has spurred the interesting approach in many jurisdictions around, for example, stable coins, which ultimately is just another form of e-money. And that typically, it was very unclear from a regulatory perspective what regime they needed to fall under, but it became clearer and clearer, at least informally, that they needed to have an e-money license or operate as an agent under an e-money license. But there are several other areas, right? There's cryptocurrencies that are just, is it becoming more and more widely adopted for mass markets, wealth management, and so on and so forth? The answer probably is yes. Probably every large custodian, every large asset manager, and so on is beginning to offer exchange traded notes, ETFs, custody services, institutional custody services, compliance services, and so on, that do address them. Some of the top ones are becoming slightly less and less volatile, becoming more of just an investment instrument. But interestingly, stepping back a little bit, you then have many large corporates trying to create ultimately their own currencies, right? So driving a surge in this idea of private money, which is also quite interesting as another trend. But in conclusion, yes, it is picking up a lot more, but there's still a lot of uncertainty as to why you would invest in it or what you would be using it for if it has nothing to do with being an investment class, because there are different categories. The Jurisdiction Task Force in the UK made some elements clear, as has the FCA. Some are regulated, some are not. But the underlying financial market infrastructure is getting to a point where they're becoming more widely accepted and adopted as an asset class, but also as just something that allows organizations to extract more value they typically only facilitate, which is quite interesting.
Okay, and James, I know you've got some thoughts on the relative approach between some overseas regulators and the UK. Just wonder whether you want to comment on that.
Obviously, I think we see other jurisdictions being more proactive and embracing crypto more than the UK seems to be. And I'm not quite sure what the reason for that is, but certainly from a regulatory perspective, my sense is that the FCA doesn't really like it because it probably doesn't fully understand it, which is why they've sought to recruit a lot of people with crypto asset experience to better inform itself. In the same way as that it doesn't really like CFDs for retail clients. I think it said that it doesn't like crypto for retail clients, but for the same reasons, I guess. But in terms of the framework at the moment, I still don't see any signposting to proper regulation. I think we've seen a consultation in Europe regarding crypto assets and sort of alongside MiFID. But given the Brexit discussion we've just had, the timing of that isn't going to work for the UK necessarily. So I haven't seen any comment on how that development is going to be adopted in the UK, if at all. And one of my observations of what is in place at the moment, and that's the registration under the Fifth Money Laundering Directive, is that whilst the registration has been open, if you like, since January, two observations. One, the application itself is comparable to an e-money institution in terms of the questions that are being asked. It's a lot of information that the FCA is asking for. And that probably leads to the second point, which is the fact that whilst that application process has been open for some 8 months, there's still only been a handful of firms that have been actually registered.
Okay, so it's a slightly uncertain outlook there. I think certainly from the FCA perhaps. I said I'd reserve the last 10 minutes of the session for questions. I don't know if we have any questions from the floor. I've certainly got some that have been privately messaged to me, but perhaps we will just ask whether anyone who is on has got a question that they'd like to address to the panel verbally. Please feel free to come off mute and ask if anyone does. Okay, perhaps we'll go initially then to some of these that have come through privately. I've got a question here from Caleb Week of Bartlett. She asks, what should UK policy towards fintechs look like post-Brexit? Gold standard regulation, perhaps following I suppose the EU standard, or is the future Singapore on terms and laissez-faire? Probably a lot to unpack on that one as well. But Ruth, do you want to have a go?
Yeah, I think that blends in well with the topic we just discussed at the end here, and maybe just to expand on what James just said. I mean, we do see the European Commission has a leaked draft of a regulation for digital assets, which I have read through over the last few days, and it's incredibly exciting. And this is all about really introducing a core framework for different types of crypto assets, asset reference token, and e-money tokens. So again, I think the question here is around laissez-faire or regulatory stability. I think there will be a significant degree of regulation required in order to create credibility. And I don't think the FCA would step away any meter or centimeter from its consumer protection angle. And the European Commission's approach in this respect is clearly around consumer protection, transparency, liabilities of providers, as well as the general setup in terms of capital requirements, auditing, etc. So we do see a similar regime to what we've seen with payment institutions and e-money institutions now coming into the digital asset space. And it's quite interesting because at some point we will see more and more overlaps between existing e-money and then people sort of issuing e-money tokens, because the actual underlying process is the same. So I think it'll maybe take a while until that leaked regulatory proposal will be finalized. But I would imagine that the UK will be watching this quite clearly and will certainly extract the consumer relevant protective elements from that. We also see, of course, research by the ECB on stablecoins and other areas. And maybe just to add around the fintech angle here, what we see in the market at a global level is that fintechs are increasingly creating the new infrastructure for a digital financial ecosystem, whether these are token exchanges, whether these are tools to do proxy voting on a distributed ledger, or to enable certain types of trading assets that was impossible to be done before using new technologies. So I think this is a space to watch. And as this infrastructure is being created, having the right regulatory backdrop from the beginning will be very helpful to make it resilient and also globally accepted.
Agreed fully, and there's a couple of additional things there, right? There's what are the policies post Brexit that the UK should adopt, and one element of that, of course, is from a regulatory standpoint, of which, when we're talking about digital assets, some of the existing common law and regulation applies quite well to it. but there are areas of uncertainty. For example, Andy, we've all spoken about security tokens many different times, and really, that falls under existing legal approaches. But there are some aspects to it that could be unclear. For example, when you have decentralized models, how things like enforcement and jurisdiction and all of those different types of things work, that the EU regulation is looking to address. But the other side that I would touch on more is what are the actual policies that are going to help fintechs thrive in the UK post-Brexit, to keep them here, to attract more, and to continue to attract investment and capital. And the laissez-faire point is a beautiful point, because typically from a kind of investment standpoint into companies and into innovation, other than research grants and things like that, it has been relatively laissez-faire. And so changing that approach by, for example, setting up some form of fintech infrastructure bank of some sort, run by the government, or some sort of fund run by the government, where, as an example, VCs, venture capital funds and PE funds, continue to rotate, in 1 to 3 year increments into this fund and manage it, right, on behalf of government and with government, to make direct investments into companies. So taking that DARPA approach from the States, which was so successful in generating innovation, and beginning to make direct investments, so that, unlike just research grants, you're investing in growing companies where the government is going to make a massive return in the unicorns and the potential listings and the expansion and so on. That approach is very, very hands-on. You begin to stimulate a lot more investment coming into the country, and you make it a place where companies want to be more established and to basically build out of, right, to address other markets globally. It becomes the headquarters. And as we know, there isn't much around a headquarter right now because of how global it is, but typically there will be a place where, the basis of a company's operations, people, executives are all based out of. And so it's a massive opportunity, again, to be able to create that environment and not stand back laissez-faire and see everything that's been built to date begin to slowly move into other markets and relocate.
Okay. I'll offer it to the floor again. Any questions that anyone wants to address verbally? Okay, I've got another one here that's been sent anonymously. You are a regulator in an imaginary jurisdiction. What is the single thing that you can do to facilitate, the number one single thing that you can do to facilitate fintech investment in your jurisdiction? Maybe, James, you can give us a view on that, having been a regulator. Was there anything that you sat there and thought, wow, I wish we did this and we don't?
Not so much, but I think I'd probably answer that question from my own experience. And having, as you said in the introduction, I headed up the authorization team for payments for a number of years, and the regulator doesn't necessarily know every business model out there, and it wasn't until I left the regulator and I went into consulting and I actually got to meet clients and actually spend some time with them and see what it was that they actually did, that I thought, wow, the regulator doesn't really know a great deal. So, we talk at the beginning that the UK probably has a good reputation, but I don't want to dispel that reputation, but don't overestimate how much the regulator actually knows about the business model. And I think what the imaginary regulator would ideally do is have an understanding of those new businesses, or if it doesn't, then reach out and go out and get itself learned.
Hazem, Ruth, from the investor perspective, perhaps, is there anything that makes you grind your teeth that regulators don't do?
I mean, maybe just to echo, the understanding of the different business models is a really big point. We've seen this in payments, in e-money, in many areas. And it is difficult because every business almost has a slightly different business model. And it's also important to understand those in terms of whether they're actually within the regulatory perimeter or not. But sort of from an investor angle, I guess also stimulating the investments, not only by VC and PE, but maybe by the retail community. What other types of incentives could be developed? We have SEIS and EIS, which are already great models. There could be an overlay around financial education to help the retail investor to participate more in this really important pillar. I very much like Hazem's idea around a government focus for this in terms of really stimulating the fintech world. And then of course, taxation in general is always a big one. I think the UK is doing fairly well on that. It shouldn't be a tax haven. So it's again about balancing credibility and being robust and resilient from that perspective.
Absolutely. And I think the final point, since we're coming at the hour, that I would make in addition to that, if I were an imaginary regulator, and we've spent tons of time working with and supporting regulators in a variety of jurisdictions. And so I agree with what was said. A lot of times they don't know, and so they do consultations and they try to meet and so on. But I think there should be a team that is dedicated in every regulator to meeting, with weekly office hours that are booked online for as many new, early stage fintechs or early stage whatever companies by category, by topic, every single week, so that there is continued interaction, and that interaction in certain instances can be made public, so individuals can be can be clearer on what's happening. And so you have that knowledge exchange going both ways. The second thing is, because there's a growth of companies, there should be, and you want to attract companies from outside, you want companies inside to, you want that funnel of the number of companies that are approaching the regulator and then getting, oh, I can't do this, or I don't know how to do this, or let me not do it and then do something wrong. There should be, and therefore the funnel of companies continues to decrease, and the number of companies that end up doing anything is limited. There should be some sort of digital sandbox instead. And when I say that, I don't mean a remote sandbox. Well, that is what's happening right now. No, I mean a technical environment similar to what's happened in other jurisdictions around open banking, where large banks want to siphon innovation from developers and early stage startups. The same thing should happen in a different way by the regulator to create that environment where they begin building and working on solutions directly with people at a technical level, fully digitally. It creates more information for them that they're able to access as the regulator to understand new models. And it's incredibly valuable from the feedback they'd be getting from the regulator. And these things can be done en masse, on volume, much more efficiently and effectively than having 2 cohorts a year of 20 or 30 or what have you.
Well, thanks for that, Hazem. We, as you mentioned, we have come up to time now. So I think we're going to have to leave it there. We've covered a huge amount of ground, I think, in the last hour. So no doubt many of you want to watch this or parts of it again. You'll be able to do so. It will be circulated and uploaded onto our eWeek website. I personally would like to thank our incredibly distinguished panel for giving up their time to come and talk to us this morning. It's been an incredibly stimulating discussion on an absolutely fascinating area. I would just finally again encourage you all to sign up for our cocktails and networking session, e-cocktails and networking session later today. You can do that again on www.entrepreneursweek.co.uk. Thank you once again to the panel, and thank you to you all for coming along and listening in. Thanks very much, everyone.
Thank you so much,
Thank
Andy.
you.